See, a number of our members are missing. They can chime in. Okay, here they come.
I'm here.
Okay, okay, here we go. Okay, we ready? Then the next three sessions centers around our ALM process, and which is a transparent review of our total fund that informs decisions to help achieve our sound and sustainable system. So the first uh, will, will be the Wilshire Associates will provide an overview of the process of asset allocation. So Tom, who's going first with your team?
Good afternoon, Mr. Jones, members of the board. I will be kicking things off.
Okay.
Great. Well, good afternoon. We're excited to provide the board with the presentation on the process of asset allocation and considerations as you embark on the ALM cycle process. Before I go on, you might have noticed that our colleague Ali Kazemi is listed as a presenter, but he isn't available today, and that's for a very good reason. He and his wife welcomed a new baby into the family late last week, and I'm not sure if he'll see this, but I did want to give him a public congratulations.
Great.
On to the business at hand. Our discussion today is going to touch on topics from selecting which assets to utilize, to benchmarking, building assumptions for modeling optimizations, incorporating new elements or characteristics into the discussion, as well as reducing the constraints on portfolio construction through the use of total fund leverage in the asset allocation. Now, there's a lot to cover, and we certainly want to ensure that the board has a full opportunity to ask questions. So fortunately, this presentation dovetails very well with the later presentation by staff on capital market expectations. So we'll really try to move through our deck in a relatively expeditious manner and craft our comments to complement what is still to come. If you flip to page 2 of the presentation, the process of asset allocation is striving to build a portfolio that helps meet CalPERS commitments, i.e. to pay the benefits that have been promised to your participants. And in the discussion of all the different complexities associated with investing in today's volatile environment, today being a great case in point with a rally to start the day and a sell-off to the end of the day, we want to make sure that we never lose sight of that goal. On slide 3, we want to just expressly state that there's a trade-off between maximizing the safety of those promised benefits while minimizing the cost of funding those benefits. And ideally, the ALM process should strive to balance that trade-off and look for asset allocations that can improve benefit safety and reduce cost to the extent possible. Now, portfolio risk and return is important in achieving that balance between safety and cost. And we'd argue that incorporating other metrics for evaluating alternative asset allocations can help provide a more holistic view into the strengths and weaknesses of different investment approaches. And ideally, this can provide the board with the tools for more robust decision-making in what is the most important decision that the board makes. And we'll provide more information on the what and the why of those metrics a bit later in the presentation. Certainly feel free to interrupt as we move through this, as again, I'd like this to be a robust discussion, and sometimes on video, it's hard for me to see who's trying to talk and otherwise. But let's dive into slide 4 and the potential opportunity set. Now, diversification has been called the only free lunch in investing. And Wilshire believes firmly that portfolio construction diversification does provide investors with the best prospect for managing through market cycles Diversification, in essence, is an understanding that we don't have perfect foresight, which is true for all investing. However, it's also important to avoid what you might hear called diversification in name only. In other words, merely adding asset classes into the optimization modeling process does not necessarily materially improve diversification. So on slide 4, we've introduced this concept of asset buckets, which is merely meant to show that there are different assets that react similarly to underlying economic drivers. So, for example, on the upper left-hand side of that chart in green, those are a collection of asset classes starting with U.S. core bonds that tend to have relatively high correlations, and that would include things like treasuries or securitized bonds, long-term treasuries, and TIPS to a lesser extent. On the bottom right-hand side are those asset classes that tend to act similarly to growth classes, such as U.S. equity, and that includes private equity, that includes non-U.S. equity, includes real estate securities, and assets like other private assets like venture capital. So we want to be cognizant of that as we look to think about which asset classes should be included in the optimization. As you look at slide 5, you can also see that there are diminishing diversification benefits as you add asset classes. And this is just a stylized illustration of the risk reduction that can be gained by adding asset classes that have varying degrees of correlation or diversification benefit. And you can see that even for uncorrelated assets, that's the bottom line in blue, as you get out to, let's call it about 9 asset classes, even if you can find another uncorrelated asset, the value of adding that from a risk reduction standpoint is a relatively minimal reduction in total fund risk. So we want to be cognizant of trying to balance the number of asset classes that are included in the optimization, and really understanding the underlying risk and return drivers of those assets, as well as what I'll call the investability or the depth of the various markets. And so I'll have us flip to slide 6.
Tom.
Yes, sir.
You mentioned that you wanted to engage in questions as we go along, and Ms. Brown had a question on slide 5. Ms. Brown?
He answered it when he explained the slide, so we can keep going.
Okay.
All right.
Okay, good.
Great, and certainly interrupt with questions. I think that's a better discussion.
Okay.
So as we look at the market opportunity set, there are a couple of considerations that institutional investors like CalPERS need to take into account when deciding whether a specific asset class can be an appropriate part of the portfolio, and that's market depth. So is there enough of an opportunity set that you can get a meaningful exposure to move your portfolio's risk and return profile? And is there sufficient liquidity to ensure the ability to transact in a reasonable manner? And keeping those considerations in mind, we think, is important. We included a couple of different statistics here, and we tried to create a tree to start at a very high level and then build out to more either public versus private or more specific implementations of a particular asset category. And in these next couple of slides, you'll also notice that some of them are highlighted in purple, and that was included as a call out to those markets which are already included in the CalPERS asset allocation. So you'll notice within public equity, you have the market cap weighted portfolio and the factor weighted portfolio. Within private equity assets, you also have buyouts, growth and venture, as well as special situations. And as you can see for those numbers listed under each of them, public equity and private equity, there really is the depth available for implementation, with north of $45 trillion in the opportunity set in public equity, and getting close to $4 trillion in private equity. One note on the private numbers, and this is an important one, is particularly as we get to the next slide, those are based on Preqin data for assets under management, so fundraising essentially, because it's hard to actually see the opportunity set in private assets. We use that as a placeholder. So just wanted to make that point for the members. So that's private, I'm sorry, that's equity. If we flip to page 7, we can see debt. You can see on the public side, for liquidity, treasury, spread, and high yield, those are all currently explicitly modeled within the CalPERS strategic asset allocation. Over the last couple of quarters, we've talked quite a bit about private debt, and that those have not up to this point been included in the modeling for asset allocation purposes, but it's one of the discussions that we'll be having as we move through this asset liability management cycle. You can see from a size perspective that public debt is quite robust, with north of $46 trillion around the globe, according to a couple of industry organizations. On the private debt side, you can see that that's large, but smaller than what we've discussed up to this point at $803 billion. But again, would caution that's the fundraising, not necessarily the opportunity set. And in fact, as we move through this crisis, the opportunity to put capital to work on the private debt side, I do think is going to expand as providers of capital are necessary for moving the economy from where we had been pre-COVID-19 to I'll call it the quote unquote new economy, which is assuredly going to look different than it had before as we move through the pandemic. We've talked a little bit about.
Okay.
Yes, Henry. Please.
Now go ahead. Now, just before you move off this chart, you finish this chart because we have a question on it. I just want to alert you.
Sure. Just a couple quick comments I just wanted to make on what do we mean by direct lending, specialty lending, and liquidity financing. So direct lending is, as the name indicates, is an agreement directly with a business entity to lend them money at specified terms for corporate purposes. And so it can run as the gamut of opportunities within that space, oftentimes to smaller companies or those that have a specific use for those funds. So middle market direct lending is one term you might have used, might have heard that would fall into that category. Specialty lending are things like equipment financing, or airplane lease financing. I'll call it more niche lending opportunities. Again, as we've seen some disintermediation from the large banks, the ability for non-bank providers to capitalize on that opportunity and help businesses navigate this current environment, I think is going to continue to expand. And then lastly, liquidity financing really refers to shorter term loans. You can think about them maybe as bridge loans to move from, let's say, development of a plant or real estate, and then utilizing the bridge loan to get to the point where it can be termed out with more permanent financing. And because it's acting, I'll say, in a pinch, you can demand terms which are quite attractive from the lender's perspective, with both shorter maturity opportunities and reasonable collateralization. So those are the comments I had on this, Henry, if there were questions.
Yeah, okay. One, a member indicated that you've already answered their question. And Ms. Brown, is that another question you are asking?
Well, he did answer my question because I wanted to know the difference between direct, specialty, and liquidity financing. But let me ask another question. Tom, you had said that we currently don't have these boxes in blue in our ALM. Is that what you said?
That's right. They're not, but let me be more clear. They are not specified target allocations within the asset allocation.
Right, because we are actually doing some of this investing, say through private equity. We did some money, was reported last month, several $billion, right? So
that's right. And there was further discussion about the expansion of this opportunity within the opportunistic strategies component as well.
right. So right now, when the staff makes these investments in either in any of these lendings, hopefully we're not doing specialty lending on airplanes. I just like to say, well, we're not doing any financing of airplanes. But when we do these, so currently they have to fit either under opportunistic or private equity because we don't have anything, we don't have a place for these anywhere else. Is that correct?
That's correct.
All right, thank you.
Okay, proceed.
Great. So if we move on to page 8, and I'll try to be relatively brief here, you'll notice that there's really only one. This is the opportunity set for real assets, both public and private. You'll notice that there's only one box that is highlighted in purple, and that's the real estate portfolio. Now that's merely indicates that the benchmark for the real assets portfolio is a private real estate benchmark, but I don't want that to I don't want to let it slide that that the real assets team is not investigating or doing diligence on things like infrastructure. Those are in fact part of their opportunity set, but the diligence really has to do a compare and contrast and consider whether the risk-adjusted returns for things like infrastructure outweigh the opportunities in real estate. So while there is only one box there, the real asset portfolio is a bit more diversified than that one box would illustrate. And then on the public side, tips and commodities have been utilized at various times in the portfolio, but they're similar to private debt, not dedicated allocations within the current asset allocation, although they certainly can be utilized if there's a tactical view within the investment team to incorporate that into the portfolio. If there are no questions there, I'm going to move relatively quickly through benchmarking. I think this is an important conversation to have as we talk about asset allocation. It really is a critical component in the board's assessment of the effectiveness of the investment program. It allows for the board to look at performance attribution, understand the underlying risk and return drivers of the portfolio. As Mr. Fernandez earlier from MSCI earlier commented, broad-based benchmarks are appropriate to capture the full opportunity set, and the CalPERS benchmarking process is regularly reviewed and approved by the board, which we think is critical as a governance tool. I'll have us flip a couple of pages to page 11 because there are a number of characteristics that we feel exemplify what you might consider an ideal benchmark. And I'll just run through them relatively quickly. An ideal bench, and when you're thinking about how you benchmark a portfolio, we had a question around private equity on this point. There are challenges, particularly in the private assets. So this is a stylized example. Not all benchmarks are going to meet every single one of these characteristics, but just very quickly, in terms of an ideal benchmark is unambiguous. In other words, we know what's in the benchmark and we understand how it's constructed. So let's say which bonds are in the portfolio or in the benchmark, and how the weight of those underlying positions is set and is going to be managed going forward. Ideally, a benchmark is also investable. In other words, it's an active choice to invest in the benchmark or simply replicate the benchmark. So within the global equity portfolio, there is a very strong index component to that. So that is, in fact, an investable benchmark. And I'd contrast that a bit with the private equity benchmark because it is a public benchmark plus a premium. Unfortunately, there isn't the opportunity to invest in that public benchmark plus a premium. That's just a method for holding the private equity portfolio accountable for outperforming the opportunity set. So again, characteristics of ideal benchmarks, but not necessarily going to hit all benchmarks. We want to make sure the benchmark is measurable because we want to make sure that you have timely data in order to understand if the portfolio is doing well. It should be appropriate. In other words, it's consistent with the strategy's objectives or style. This isn't so important for the CalPERS portfolio, but you can think of a growth equity manager. You would not want to benchmark them to a value or core equity benchmark because there's going to be significant mismatch between those styles. So you want to make sure they're consistent with the style and objectives of the investor. Reflective of current investment options, I think probably not worded great from a characteristic standpoint, but that is essentially the acknowledgement that the investor knows what's in the portfolio and understands and can have an opinion on those benchmarks. And it's having that opinion that allows the investor to overweight those that they like or underweight those that they do not like. And then importantly is pre-specification. And that's the idea that you should agree to a benchmark at the beginning of the period and set it, as opposed to waiting until after to the fact to say, well, actually, over the last year, our benchmark was Y. You want to set it in advance. And as part of the transition process after the last asset allocation, the board set in place a process whereby staff did exactly that, specifying the benchmark weights up front and transitioning in a measured way, a pre-specified way, to the new asset allocation over a period of time. Any questions on benchmarking?
Yes, this may be a question for staff if you don't have the answer, but during our educational session in January, where we were being provided information on benchmarks, there were a couple that I had asked a question about that were not investable. And staff, I think at the time, said that they were looking at those and they would review them to make that change because they all should be investable. So the question, if you don't have it, then I'll just defer to staff that did we make those changes that now all our benchmarks are investable? Well,
yeah. Do we have Dan in the call?
So, Marcy, this is Ben. While we're waiting for Dan to get online. So, Henry, I do not recall that discussion in January, but I can say that, we have been trying to find the investable benchmark in private equity. Unfortunately, in private equity, that's what Tom is referring to. There's no such a investable benchmark in private equity. So that's the short answer to your question, unless you were referring to a discussion on a completely different topic. On private equity, in a way, on private real estate, it is true as well that there's no investable benchmark.
okay. I will go back and see which benchmarks that were being referred to and send that to you. Okay. Okay. Then we do have a question. Do we have a question from Ms. Brown on this slide?
Yes, yes. And actually, I wanted to go back to just a quick question on slide 8 on tips. I just wanted to know why those inflation protected securities, why they are in real assets instead of fixed income.
Ms. Brown, a very fair question. they are hybrid security in many ways, and you might say it's just merely a categorization choice from myself, from Wilshire. As you look at, you could fit them within public debt on page 7, but they do have that very, I'll say, unique characteristic of the inflation adjustment. And given that real assets, from a strategic perspective, is meant to provide that inflation protection, that's why I included 6.
Great. Okay, so back to benchmarking. We talk about, I don't know how the benchmarking is going to work when the benchmark will change with the assets that are held. I mean, we set an ALM, we tell them what assets to hold, but now the benchmark is going to change with what the security holdings are. I mean, I don't know how that works.
So I believe the process you're referring to is the quarterly benchmark adjustment for basically the split between public assets and private assets, and setting the proportion that is equal to private assets to its weight at the beginning of a particular quarter. So that does, in fact, it is pre-specified. So it is one of those characteristics here. But it's just a realization that on a quarter by quarter basis, staff does not have the ability to rebalance the portfolio to move the private equity weight or the private real assets weight back to its target, because it is somewhat reliant on the cash flows and capital calls and distributions of the underlying managers. So that's the balance that's trying to be struck with the benchmark weighting on a quarterly basis. But importantly, and this is a discussion that Wilshire had as we were coming up with this methodology, for the private equity portfolio, the full premium that you're looking to gain from that investment is incorporated into the total fund policy benchmark. So you are holding staff accountable for the full target allocation weight within private equity, because that is essentially added on top of the performance of the underlying benchmarks.
Okay, and then on page 11, you did sort of say, when we were going through these little tables here, that this doesn't necessarily work for private markets, because we don't necessarily know the securities that we're holding. Is that correct?
That is correct. Many of these characteristics don't hold very well for private asset benchmarks.
All right, thank you.
Okay, no further questions at this time, Tom.
Okay. Just one comment on slide 12 before I turn it over to Steve. I just wanted to make the point here that sometimes when we talk about active and passive management, that gets what we think kind of mixed up in the asset allocation decision. In our view, the decision to be actively managed or passively managed comes after the asset allocation process. So it's what we call investment structure, and that's looking at the risk factors that are incorporated within asset classes, as opposed to how much do we want to target to each asset class. So just wanted to make that comment here, and that's why you won't see us refer to the decision to be active or passive in a strategy in the balance of the presentation. So I will turn it over to my colleague to step through asset class expectations.
Great. Thanks, Tom. Good afternoon, President Jones, members of the board. And I will move, if we can jump to the next page. Thank you. I'll just shift to talking a bit about the asset class assumptions. So I think Tom set up very well the exercise of going through understanding what the potential opportunity set is, what the components, if you will, of an asset allocation study might be. I'm going to now shift to talk a little bit about deriving expectations for those segments. And we have about 5 or 6 pages in this segment, which I will move through rather quickly, not because this is not an important piece of the puzzle. I think it's a critical part of an asset allocation study, the quality and the rigor that goes into the assumptions, but because you've got a 3:30 session this afternoon that's been referenced a couple of times where Diane Sandoval and Allison Lee of staff will be going through a much more detailed discussion of capital market assumptions and different methodologies. But I do want to set out the main components of assumptions that are required to perform optimization work and try to identify possible efficient candidate portfolios. And the main three are depicted on this page, and they are namely what's the expected return. And in this case, when we're talking about expected returns, the horizon we're generally talking about, and is true with Wilshire's assumptions, is long-term to the extent of about 10 years. And in the sense of a pension plan, 10 years doesn't sound particularly long-term when you're thinking about perpetual liabilities that go out decades further than that. But long-term in terms of capital markets and understanding that you likely do not want to be shifting a portfolio very frequently and understanding the potential trade-offs between asset classes. So the assumptions that we'll talk about, and indeed, as you move through your ALM cycle beginning next year, the assumptions that'll be fed into that will be about that 10-year sort of horizon. So the return would be the geometric, or think about that as a compound return. And that would be the expectation if you invested $1 in a particular asset class. That assumption would be, the way to conceptualize it would be if you were able to compound that dollar by that return. So it's not an average or arithmetic return. It is the compounded amount of that return, which means, you know, at a 10% return on $100, that would go to 110, and then that 10% would compound on the full $110. Now there's risk around that, which brings me to the next component of the asset class returns, which is volatility, kind of conveniently collapsed down into a term risk. And this is clearly just one form of risk, and Tom and I will circle through, as we go through the presentation today, other forms of risk. But here we're specifically talking about volatility, which is the degree of dispersion around that expected return assumption. The more volatile an asset class, the wider that dispersion. We've got depicted here with this histogram. The less volatility, you have a much tighter histogram around the expectation. As far as understanding the return and risk of an asset class, that's really all you need, again, for that narrow view of risk. But in terms of understanding how asset classes combine in a portfolio, a correlation becomes another very important input into the process. And what correlation tells us, and we try to have a depiction of it here with this XY scatter plot, is essentially the relationship between the risk of asset classes. So the co-movement, if you will. How, if you know something about one asset class, how much information does that tell you about another one? And correlations fall in a range of +1, where asset classes behave exactly consistent with one another. And if you look at this scatter plot, a correlation of 1 would essentially be a upward sloping line where every point falls exactly on the line. And that's to say that if you know the return of one asset class, that correlation of 1 tells you know the return of the other asset class. That would clearly not give you much diversification. As you start seeing these scatter plots scatter around the line, that is telling you that there's less and less co-movement, if you will, between those asset classes, and you start getting a lower and lower correlation until the line eventually goes flat and then even starts sloping downwards. And this is where you're now moving into negative correlations, where actually the movement of one asset class moves in opposite direction, if not a -1 moves in opposite direction. So correlation becomes critical when we're combining asset classes, and as an important piece in understanding what the overall risk of a portfolio is. So these are the three main pieces of information as you work through and staff works with your external advisors on developing the published list of asset class assumptions for your study. These will be the main components. Again, return, risk, and correlation. These next slides I'll move through rather quickly.
Could you hold on a minute, Steve? Ms.
Sure.
Oliveris, is your question on this slide? Ms. Oliveris, I guess not. you're in the queue. Okay.
Oh,
Proceed.
sorry, I was muted. Sorry about
Okay.
that.
Okay.
It was on my question was on the previous slide. I just don't think
Okay.
it was on
Okay.
private equity benchmarks, but it's okay. We can just pass it and just keep going forward.
Okay.
Okay, if we could jump to, I think it's 14 in the deck, and let me just offer up one caveat, and again, other than I'll move quickly here. Unfortunately, because of the timing on when materials were required for this particular educational session, these slides that I'm going to cover are based on Wilshire's March asset class assumptions. You can imagine just how volatile an environment it is, and I'll touch on a couple of, how radically changing, how quickly and significantly changing some of these assumptions have been. But where it makes comments about last quarter, that's Q1. We just last week, finished up our work on the capital market assumptions for the June valuation date, and I'll be happy to make just some comments about direction and magnitude of some of the changes. But just to get that caveat out of the way. I think conceptually the easiest way to think about capital market assumptions, and I'll leave the heavy lifting to Diane and Allison later this afternoon, is to think about trying to capture the various risk premia that are embedded in different asset classes. And while we don't directly perform our modeling work in a building block approach, where perhaps you'd start with inflation and then add cash onto that, and then duration risk and credit risk and then equity risk premia, I think that's a good way to think about conceptually the exercise of trying to derive capital market assumptions, which is namely, what is it we think we get compensated for? What size of compensation? What's the risk to that compensation as you stack various forms of risk onto a portfolio? And here on this page, if you're starting with inflation and Wilshire, and I don't think this is anything that's really different from if you looked at other advisor assumptions. A key input to our inflation assumption is merely the break-even inflation rate that one can observe in the bond market. And since I mentioned our assumptions are 10 years or targeted at that duration, we're essentially looking at the implied break-even rate in 10-year nominal bonds versus TIPS. And I won't go into detail here, but to say occasionally we step outside of that signal. And because of what we perceived as many of the distortions in the market when we were doing this work in early April for the March valuation date, we actually did step out of the break-even signal, which had fallen off the table by about almost a full percent. And we didn't take that full percent move and actually published a bit higher inflation estimate than was out there. We've since even raised that with our June work. So we start with inflation. I think that's important, not because it's an investable asset class, but it happens to be a very important input into other asset class or capital market models. So if we can jump to the next page, please. I'll touch just briefly on two main segments of assumptions and won't go into each asset class, but generally speaking, fixed income. The main drivers, and I'll make this statement across all asset classes, essentially you're looking at any income, meaning known cash flows that the investment kicks off, any potential principal change, so valuations, how investors are going to pay for $1 of cash flow, and then changes to those cash flows. And that would be, you can think about that as growth. So in fixed income, that growth component is not that important. It's really just what the level of income is, thus the name fixed income, and how are markets today paying for that, namely the yield. And simply, if you think about, for some classes of fixed income, that what I'll refer to conveniently as the going in yield tends to be a very good predictor of future returns. Now that differs depending on the nature of the fixed income investment, its duration, the amount of credit risk. So the other components that are important to pick up are views on what the interest rate environment in the future is. And that impacts the potential return in a couple of ways. Number one, if rates rise from a principal perspective, that's going to push values down. Prices have an inverse relationship with yield changes. But on the flip side of that, if you think about the income that's being kicked off of a fixed income investment, that capital gets reinvested. And if rates are rising, it's getting reinvested at higher yields. So depending on the length of the duration, some of that reinvested income at a higher level, if yields were to rise, works against some of the losses from the principal. So obviously, if you're long duration, the principal hit is probably quite a bit larger than what the reinvestment rate is going to pick up. If you're in very short duration assets like cash, there's almost no principal hit, and really the reinvestment rate is going to dictate what the change in the assumption is from today's yields. And there happens to be a sweet spot where it pretty much nets out. And so I will just say not every capital market assumption is equal. And when it comes to fixed income and certainly things in the intermediate term, think about Barclays aggregate, very straightforward, high confidence assumption because of those netting out properties of even if you'd get the future interest rate change wrong, the higher reinvestment rate against the principal hit tends to net out to essentially deliver that going in yield. Jumping to the next page, and I'll be real quick here. This just shows the yield environment. We had just a huge drop in yields early part of the year into March. That hasn't switched around. The yields have actually, if you looked at the June curve versus what I'm showing you here for March, it's actually ticked down just a little bit. But you can see because of yields coming down and the comments I just made about how important that yield environment is, Wilshire's assumptions for high quality fixed income were down anywhere around 1% on the high quality core segment. Quite the opposite was true in our high yield assumption because during this period of time in the first quarter, spreads blew out. And while we do factor in default rates and recovery rates, those broader spreads push the return assumption out. So again, don't want to get into too much detail here. I'll jump, if I could, to the next page, which starts opening up a discussion of equity markets. And I'll touch on three models that we use and really just to paint a conceptual picture of different methods for forecasting equities. And again, I'll leave it to Diane and Allison to go into more depth on these. But I mentioned the three components of all asset class potential forecasts, which would be income, growth, and then valuation. We actually refer to one of our equity models as an IGV model, which captures those three components. And I have it in these column charts depicted with our March assumption for the IGV model against what equities have delivered through an attribution against these components post-World War II. And that would be a period, if you look at the red bars to the right here, 11% or so return on the S&P over that period of time versus our March IGV signal. And by the way, this was larger than Wilshire's assumption, but it gives you an idea of, oftentimes I think you'll hear questions, well, why if I've received, 10 or 11% on equities for 50 plus years, should I expect less? And I think going through a component model like this is a very helpful way to understand that exercise. I will tell you that this IGV model, if you looked at it from December to March, it jumped up about 2%. And that speaks to the huge sell-off in the first quarter. And our December number has this nearly 8% number coming back down to about 605. So that speaks to the volatility. And that's, I think, an important point. In a typical, and I'll put quotes around normal market environment, our assumptions, and I think other advisors' assumptions would probably change very little from quarter to quarter. That is, couldn't be farther from the truth in the recent period of time. And I think it speaks to some of the challenges in managing long-term assets. You have the opportunity to rebalance when there's market volatility, but responding to every wiggle in capital market assumptions, even when they're 10 years out, captures some of this extreme volatility. I'll jump to the next page if I could, and just talk about one other model. And this is a CAPE, which is a cyclically adjusted price to earnings ratio made famous by Professor Robert Shiller. And just to give you a picture of how important valuations are to future returns, and I'll just touch on the left graph here. This is essentially that cyclically adjusted PE ratio. And what cyclically adjusted means, it's taking the earnings instead of looking at earnings today or maybe expected earnings a year out. It's taking the last 10 years of actual published earnings, and the cyclical adjustment part is bringing the previous earnings forward by the inflation rate, and then accumulating that last 10 years into one earnings number. And what that does is it takes some of the sensitivity out of going from quarter to quarter and just looking at the current earnings. The other line in this exhibit is the forward 10-year return, in this case to the S&P 500. And, I think these lines are not obviously right on top of each other. Actually, this is just Excel, charting it on its own without anybody forcing these to look similar. But you can see how strong a relationship. This is without making any forecast about earnings. just simply taking that CAPE measure and saying, what's the relationship to that environment heading in? Just like I said, high confidence on fixed income to look at the yield. This suggests that it would be a pretty good starting place just to start there in terms of even deriving equity forecast. So this is one of the signals we use, along with the IGV, along with a dividend discount model. We also, and this is the chart on the right here, we also find the CAPE to be very helpful in terms of understanding relative relationships between regions. For example, let's say the U.S. equity market versus the developed ex-U.S. market versus the emerging markets, and looking at relative CAPEs against relative performance through time, and trying to get an understanding of the sensitivity or the predictive power of those relative relationships. I'll pause for a second before I jump, Mr. Jones, to see if there's any questions. Otherwise, I can push through.
Yes, thank you, Steve. Yeah, Mr. Perez has a question.
Steve, back on slide 16. The variables that you use to put that, are those the previous two slides leading up to this slide with the U.S. yield curve? So what's the what are the variables that you use? It's the your model.
Sure. So for fixed income, the variables are, number one, just observing what current yields are. Number two is we for each benchmark or index that we derive an assumption for is understanding against, we'll essentially sketch out a future yield curve, which is to say our estimate of where we think yields are going. And that's not a heroic exercise. It's, a large part of it is looking to what's priced into future curves. So that helps with a view on what happens to rates in the future. And then an important part of it, and this isn't so important when you're looking at treasuries, but it becomes much more important when we're looking at investments that have credit risk, and think about moving out to high yield or below investment grade, is to get an understanding of not just the spread of these investments above treasuries, but the expected default rate and then the recovery rate. And we base much of that off of observations about historical experiences, what default rates are over time, and that will modify from time to time and will be based on the environment. But essentially, once you put those inputs into the model, you build out a cash flow expectation going into the future, and then we simply look for the discount rate or the internal rate of return that would explain the price to purchase that future set of cash flows against the realization of those cash flows. Does that get at what you were asking, Mr. Perez?
You explained it, but it's still confusing. But we can spend the rest of the week explaining it to us.
It is kind of a presentation in itself, and I do apologize for moving quickly through it. If we could, I think, move forward one more slide. And this is just a summary, and I think it speaks to the comment I made a couple of minutes ago about, the rate of change, certainly as we move from December to March. The bad news was equity markets sold off a lot. The good news was our forward-looking outlook was that you push some of those returns into the future. And, I spoke a lot about the impact on fixed income because of the falling yield environment. I will tell you, as we move things forward to June, now here the good news is fantastic returns to equities in the second quarter. And in fact, I think it was the best quarterly return over 20 years. That's the good news. The bad news is, some of these higher return expectations have come back. And while we haven't pulled the entire 100 basis points or percent increase that we printed in March, we have pulled back 75 basis points, so almost all the way back to where it is. So in the end, and we'll circle back to this later in the presentation, this capital market view, and I don't think Wilshire's assumptions differ much. There's obviously variance around, some of these, particularly the more, volatile of asset classes. But the picture they paint in terms of future returns and the modest nature of those returns, creates some challenges for investors such as CalPERS and others, and quite frankly, retail investors, even though they might not be aware of that. And we'll touch on some of the ways to manage that as we move forward here. So if I could jump to the next page and talk a bit about, so now this is an efficient frontier of taking a group of investments, deriving assumptions for them, and then whatever number of assumption or components we have, building out mathematically through this optimization process an efficient portfolio. So at each level of risk, what is the best portfolio from a maximum return perspective that can be built? And this is, it's interesting. It's under the header of modern portfolio theory, and the father of that is Harry Markowitz, and it's got the label modern on it, but it was in 1952 that Professor Markowitz, did this seminal work, and it gives you a sense of how long it's held up. And there's been advances on this, but very much at the root is a strong mechanical process that's been in use for coming on 70 years now. I find it a little bit depressing as I sit here in my mid-50s that Markowitz was able to pull this off when he was, I think, about 25 years old. So kind of speaks to some of the accomplishment here. But I want to make a couple of observations, and we will again circle back to this. This is a frontier that looks at all the options that are given to it, the assumptions around those options. And one observation, along this frontier, again, the efficient portfolio at different risk levels, you'll notice the shape of the frontier as you move to the right or up, higher and higher returns, the slope of the line diminishes as you go. So it has a diminishing slope return, and the slope of the line speaks to essentially the ratio of return that you're receiving for each unit of risk. So a diminishing slope of this line, you can see it starts to flatten out the further you go, suggests that for every incremental unit of risk that you add, you're getting less and less compensation per unit of risk. It's just the nature of efficient portfolios, the embedded diversification in these portfolios, which is a really important point that we'll circle back to in this presentation deck. But I wanted to paint that picture. The next place I want to go is talk about constraints on the process. And before we switch pages here, just picture this frontier. Any limitation you put on it can only move the frontier in one direction, which is down and to the right. Meaning, as you add constraints, you can't get better solutions. All you can do is restrict the potential opportunity set of solutions. And sometimes constraints barely move the needle. Other times, the quote-unquote cost of that constraint could be significant. So as we shift to the next page, I did want to touch on some constraints because there are very good reasons you might want to, layer in some constraints on an otherwise unconstrained optimization process. And it starts getting at investor aversion. It starts getting to legitimate practical issues such as cash flows and liquidity. For an investor such as CalPERS of size, it can be very helpful in terms of managing the ability to invest in a particular market segment where its size might not allow for huge investment. So it's a way to put a maximum on those sorts of investments, to put a minimum on the amount of liquidity in cash. And Tom and I will circle back and talk a little bit about liquidity from the perspective of how Wilshire looks at it. But constraints are a mechanism to control for some of those variables. And we'll talk about this and be an important conversation when we circle around to leverage later in the deck. On the next page, I wanted to just kind of wrap up or summarize some of the strengths and weaknesses of modern portfolio theory in this optimization process. I think hopefully it's very clear that it's a powerful construct. The inputs that go into it are pretty well known, pretty well understood, relatively, if not simple to know the future, at least simple to think about the models that might be good predictors of returns and the risks around that. And then a really elegant, powerful way to combine asset classes in an understandable way to understand efficiency and what some of those important trade-offs are. Some of the problems come down to sensitivity to those inputs. I think the more you know about those areas of vulnerability and sensitivity, the easier it is to constrain and to control for those. The one I really want to focus on is instability in correlation. So if you think about, as I set up what the important inputs are, correlation was one of them. And for each asset class pair in the input set, there's going to be a single correlation assumption. Well, just to show you how volatile correlations can be, the graph we have here is essentially a 12-month or a 1-year rolling correlation of global stocks against core bonds, so the Barclays Ag. And you can see, remember, these would fall in a range of 1 to -1. And while they don't touch those extreme points, they're covering quite a range here. And it gives you a sense of the optimization and the expected risk of portfolios could vary pretty significantly based on how asset classes are performing at various periods of time. And this is an important thing to note, because this is why oftentimes we see that we experience that sometimes portfolios can express a little more risk than one might have expected from the assumption suite. This is one of the main culprits for why that is, and there are some tools and techniques to try to manage around this, which is where I plan on going next in the deck. So if we could move to the next section of Mr. Jones, I'll just pause for a second just to see if there's any questions before I do that. Nope. Okay. So I want to talk about economic factors, and by economic factors, think about high-level growth, inflation, GDP changes, the importance of that economic backdrop against the reaction and the response of various asset classes. Because at the core, the instability that I just spoke to in correlations is actually pretty well understood if we're aware of the underlying economic environment. And at times when stocks and bonds seem to be expressing high correlations is probably a time when something like inflation changes are affecting both of those and has the same influence on them. At times where they look like big diversifiers and they have a negative correlation, it could be a time where something interesting, either extreme growth or a slowdown in growth, is affecting pricing, and stocks and bonds are going to have opposite reaction to growth surprises on either side. So understanding the economic backdrop is critical. So as I jump to the next slide here, the goal, and again, the exercise here is to hopefully be able to find tools and data points that can help us, understand some of the vulnerabilities in portfolio and build, at least have the option to consider building more resilient portfolios. So here we're looking for macroeconomic factors. There's no end really to the number of economic data points that get printed. Some are monthly, some are quarterly. Some are released with significant lag, others are more timely. In the end, we are looking for factors that most importantly have a connection to asset class prices. Their pattern is intuitive, it's well understood. We want to make sure that we can measure that connection, because in the end, if it's instability of correlations we're trying to fight, we want a relationship that's more predictive when attached to some of these factors. So measurable and a high degree of accuracy is important. We don't want to throw the whole kitchen, everything in the kitchen sink in here, so we want to keep it a bit limited. We don't want to throw in multiple factors that are meant to measure the same thing. It also tends to lead to a model that's very difficult in practice to get any benefit out of. And I think the last two, so I mentioned GDP as a potential factor. It seems like a perfect factor. If we want to measure growth, what could be better? One of the issues with GDP is just the frequency. It's a quarterly number. We might want to understand asset movements more frequently than that. And the second issue with GDP is you don't get a glimpse at it at the time period where it's relevant. It gets published after the time period. So we need to try to find things that are much more connected to even day-to-day type of moves. So if we can jump to the next page, and I think we kind of jokingly talked about earlier, Mr. Perez, when we were talking about the returns, that kind of a separate presentation in itself. And I, here I do apologize. This is actually a series of research papers that Wilshire did. It is a separate presentation. So I'm going to gloss over this because I do want to get to what the practical use of these are. But in the end, if we can find these factors, we can incorporate them as another signal or tool, if you will, when looking at portfolios to understand the vulnerability of these portfolios beyond what those static correlations might lead us to believe. That puts us in a position where we might be able to find portfolios that protect against some of those identified vulnerabilities without sacrificing too much in the way of return. So really, that's the pursuit. That's what we're trying to do. Those are the benefits. Some of the complexity is it's another set of data. It's so it adds to some of the complexity of the work of portfolio construction and identification. So with that, moving to the next page, here we're basically, this is just connecting interest rates to growth. And I'll just step through this very quickly, and hopefully these charts are pretty intuitive. Top right is taking the nominal 10-year yield on treasuries and connecting it to a rolling GDP. And while these lines aren't one on top of each other, you can tell that they're, nominal yields are not just some random thing. They are connected to the economy, and I think this chart helps show that. Now, that doesn't become that useful a tool to us because embedded in nominal both GDP and interest rates is information about inflation as well as information about real growth rates. You move to the chart on the lower left, I'm doing the same thing here, except now I'm taking real GDP growth and charting that against the real yield on, in this case, the tips. And you can see strong relationship again. And this is essentially saying if we look at real yields and we look at their wiggles, their changes from day to day or month to month, that tells us something or can be very useful in terms of telling us something about how, at least through the bond markets, investors are pricing growth. Are they pricing for increased growth, decreased growth? The chart on the right does the same thing for inflation. So not important to know all the details here. We don't have the time today to even go through it, but I want to present this because on the next page, I think this is where it all hopefully comes together. So the following page, and we figured out a way on a two-dimensional application here, a piece of paper, I guess a screen in this case, to have really 5 dimensions of information. And let me get the first 3 out of the way that are really straightforward, and then get to the real important ones. So bubble size, these are asset classes. The bubble size represents Wilshire's expected return. So the larger bubble, the larger the return. So the exact size is not that important. It's really the relative size from bubble to bubble. The color of the bubble is the segment that the asset class would fall in. So Tom talked about that bucketing process earlier. Growth assets would be blue in this application. The gold ones would be real assets. Green would be high quality or fixed income. And then the light blue is credit or high yield. And then the solid would be public market assets. Gradient would be private markets. So those are 3 of the dimensions. The 2 that I want to focus on are the economic factors. And that's the horizontal, or the x-axis, which is growth. The bubbles or asset classes to the far right would be those that have a positive sensitivity to growth. As growth is accelerating, those are the asset classes we think do really well. As growth decelerates, those are the asset classes that really suffer, and vice versa as you move to the left. I do, and I apologize, I have to make a couple of just data corrections to this chart, which is unfortunately, as the team pulled this together, 3 of these bubbles got plotted incorrectly as they relate to growth. So unfortunately, it looks like this would be easier to get more diversification away from growth than it is. But if you look at the gold circles and the ones that are just to the right of the axis, so I'm talking about global real estate, the solid gold, and then just above that, infrastructure, those should actually slide over just about to where U.S. equity is. So they have much more growth exposure, and they were just plotted incorrectly here. So I apologize for that. So if you could, in your mind, picture those being, just nestled up to the left edge of those blue circles for non-U.S. equity. The other one, if you go straight down from the 2 I just asked you to move in your mind, would be corporate bonds. That should be right on the axis to the left. So that one should slide to the left. So apologies there. That tells you about growth. The vertical is inflation. As you move to the top, those are asset classes that if you have increases in inflation, you would expect to perform very well. They have sensitivity to inflation and would suffer with lower or deflationary environments, and then vice versa. The goal here would be to try to build portfolios that have a little less sensitivity to surprises in these factors. And in the end, if the theory is these are the factors that drive asset pricing, which I think is a pretty uncontroversial view, and I'll note that if you put a traditional portfolio together, something that looks like, CalPERS or most portfolios that have, a fair amount, 50% plus of equity exposure, they're going to plot just to the right of where you see the high yield, that light blue portfolio. So they have heavy growth sensitivity. I don't think that's a surprise to anyone. But if you look at this from the perspective of, okay, well, what are the assets that might be good diversifiers? Well, the candidates would be things to the left of that. Here's a critical observation that I think this will be the second time it's come up. It'll come up again as we go forward. If you were to look for more diversification, you need to essentially sell out of some of the asset classes to the right of where the portfolio would be to fund investments in some of those asset classes to the left. What you will notice is most of the larger bubbles are to the right. So that also means you're funding lower returning asset classes with higher returning asset classes, and as you're reaching back for this diversification, you're sacrificing an expected return. Look, I apologize. I know I've gone through some pretty complex stuff here in a really rapid way, but hopefully this schematic becomes fairly intuitive. And if you think about an ALM exercise and considering candidate portfolios, you can look at them through this lens and plot them and get a sense for, hey, is there a way we can push a little closer to the axis, squeeze a little bit of that growth risk out of a portfolio and do it in a way where we're not sacrificing too much, if anything, in return. So that ultimately this is packaged in a fairly limited way, but lots of potential value to exploiting some of these tools and techniques when reviewing portfolios. I'll pause there before handing back to Tom for the next section in the deck.
Yes, Steve, we have a question from Ms. Brown.
Sure.
Thank you. I hope we could get that replotted for us so I could put it in my slide deck because I'll go back and refer to it. Steve, the question I had is, what is the definition of private markets for this graph? Because I see private infrastructure and then I see global real estate, which a lot of our real estate is private market. So I'm just curious as to what's in that blue bubble.
Sure, and I will we'll definitely make sure to update this chart, and we can work with staff on the best way to distribute that. These are essentially Wilshire generic assumptions. So private markets here. So we model many of these I'll call them subclasses to private markets. So U.S. buyouts, non-U.S. buyouts, venture capital, distressed debt, mezzanine debt. This is a basket with, I think it's 70% is buyouts, 20% is venture capital, and 5 each to mezzanine and distressed debt. So it's a diversified, it's not CalPERS approach to private markets, although it probably wouldn't differ much from where it's plotted and the size. But this is that kind of generic private markets Wilshire basket where we just conveniently publish a number around that basket.
I appreciate that because I was confused when I saw that. I was thinking CalPERS, not Wilshire's basket. All right, thank you.
Yep, you bet. And these are, we tried to put at least the sorts of asset classes that you look at, but these are Wilshire and not custom to CalPERS.
Thanks.
If there aren't any other questions, I'm going to hand the baton back to Tom.
Okay, proceed.
Great, thanks very much, Steve, and thank you for the questions. So that's the first additional characteristic or a tool to utilize within asset allocation process. The second is related to liquidity. So if you can flip forward to the next 2 pages, page 29 of the deck. Oh gosh, and it looks like the risk lens has got marked out here, although I've got it on mine here. Suffice to say, we think that liquidity is one of the 6 essential risks that investors need to manage in order to have success. I don't think that's a controversial statement, but the details and the intricacy of managing liquidity can get pretty complex pretty quickly. And so one of the questions which came up in a prior investment committee meeting was, well, what are some best practices in terms of managing liquidity? And so we wanted to try to address that question here in this section. On the next slide, probably the most severe outcome for an investor that lacks liquidity or has insufficient liquidity is default. But there are other very disruptive impacts that can also impact an investment portfolio. And that's essentially that if an investor runs into a situation where they have less liquidity than they would like, they might be forced sellers within a market. And that moves the portfolio away from the strategic asset allocation and really robs the investor of that ability to recover from market sell-offs. And as stated in the CalPERS investment beliefs, one of the key benefits CalPERS has in the market is its long-term investment time horizon. And if liquidity is not managed appropriately, that becomes a challenge to maintain that long-term outlook. So I talked about how a portfolio can be torn away from its strategic allocation. So I'll skip over page 31 and move us to page 32. And this starts to get into what we think of as the best practices for liquidity management in a portfolio. And then I'm going to link it to the asset allocation process. So as you think about liquidity, we look at we'll call it a tiered hierarchy here, ranging from full liquidity, which is cash that's available for any use. It hasn't been earmarked for anything, all the way down to convertible liquidity and delayed liquidity. That is, for convertible liquidity, there is some access there that can be sold within a certain period of time. Delayed liquidity, you can think about all private markets as sitting within that bucket. Given infrequent openings, lack of liquidity, incredible discounts that would need to be taken to dispose of private investments, those should not be considered ready sources. And so as we look at approaches, so those are some of the terms that you'll hear throughout this section. On page 33, we start to get into that best practices and the approaches for managing liquidity. And I think it's important to think about it in two main buckets, one of which is related to asset allocation. So the first approach is direct, and that is setting aside a minimum percentage of assets to meet cash obligations going forward, as well as maybe a cushion to manage against unexpected outflows. This has the advantage of saving the investor from being a forced seller in down markets through we'll call it a more orderly cash harvesting process. When you think about the direct approach on page 34, that is the day-to-day management of cash. And we have a relatively simplified framework laid out here. As you've heard us discuss in the past, the CalPERS liquidity dashboard offers a much more granular look at the uses and sources of liquidity within the portfolio over multiple time horizons. But you can think about areas of the portfolio that are readily convertible into liquidity, whether that's the treasury segment, the income segment, parts of the income spread segment, or public equity. As I mentioned, delayed liquidity would capture all of the private investments, as those are areas of the portfolio that are unlikely to be accessible for liquidity at any reasonable price. So from a best practices standpoint, CalPERS has the direct approach within their day-to-day portfolio management process. So I'll turn to the next approach on page 35, which we label as the indirect approach. And this is the one that's most pertinent for asset allocation discussions. And it's an attempt to quantify the level of liquidity for various asset classes across the spectrum, so that when the board and the investment committees are discussing alternative asset allocation targets, you can understand if there are trade-offs in terms of liquidity. And the way we've done that is Wilshire's liquidity metric, which we think is an improvement on the binary private asset versus public asset distinction within portfolio construction, because it provides more information and again allows you to assess the trade-offs by capturing some of the characteristics of different asset classes in terms of their ability to be converted into liquidity in a reasonable time frame. So, as Steve mentioned with the factors, we do have research and papers associated with this liquidity metric, which we'll be happy to share with the board, which goes through kind of the process for determining what they are. But if you turn to page 36, it lays out what the how we come up with them and what the final output is, and that's determine what we call a market level of liquidity. And then what I think is probably the more important metric, as we talk about asset allocation, that's the stressed liquidity metric. And so I'll focus on my comments there. The stress liquidity metric is really trying to define practical liquidity given an asset class's volatility and sensitivity to various economic environments. And it essentially incorporates penalties across 3 dimensions, growth and inflation, and then risk environment or a volatility penalty. And so the simplest way to think about it is for an asset class like global equity. During the normal course of business, it is a relatively liquid asset class, which can be sold in order to generate liquidity or sold for rebalancing purposes. During more stressful environments, there might be larger bid-ask spreads within that area of the portfolio, and you might not like the price that you receive for selling those assets in a riskier environment. And so we try to quantify those penalties into that stressed liquidity metric score. For things like private equity, those are already having a 0% liquidity score associated with them. So we maintain those liquidity metrics for our full suite of asset allocation assumptions, much like we do for the factor exposures. So we think this is another useful metric to utilize in discussions about alternative policy portfolios that improves on looking at just risk and return, and starts to look at things like economic factor sensitivities as well as liquidity. And so if you flip to page 37, I'll wrap this section up real fast. You can see that this asset class assumptions matrix has more inputs essentially. Steve mentioned earlier expected risk and return. You can see those are listed there as well. But we've added in the factor exposures and the liquidity metrics. And then you can see the correlation matrix below that. So we think this allows for more robust discussion when you're looking at different alternative policy portfolios. Which brings us just to the last slide in this section, and that's on the asset allocation process. I started off by talking about the balance between maximizing safety and minimizing cost. The ALM framework strives to provide options for improving on both goals, or certainly at least taking into consideration both goals to come up with the ideal asset allocation to help meet CalPERS investment objectives. So I'll stop there and see if there are any questions before we move on to what I think is going to be a really great discussion on portfolio constraints. Not hearing anything. I'm going to turn it.
Proceed, Tom. No questions.
Thank you, Mr. Jones. I am going to turn it back over to Steve to start the discussion on leverage as a tool in asset allocation. And take it away, Steve.
Great. Thanks, Tom. And I think we've got about 10 minutes left, so I feel a little bit like Willy Wonka when I say so much time and so little to see. Wait a minute. Strike that. Reverse it. So leverage is a huge topic, obviously something that staff and board are focused on and discussing. If we could roll forward to the next, right here with the efficient frontier. Talked about this quite a bit earlier, so I won't spend a lot of time other than to just set up a point I made earlier, which is what happens as you move up and to the right on a frontier, we have two very simple portfolios noted here, and these are simple to the extent that we're just looking at stocks, bonds, and cash. And you can see in portfolio A, and by the way, this is a modest returning 4.3 portfolio, fairly well balanced. That 30% weight you'll notice to stocks from a risk contribution is actually 2/3 or so of the risk of the portfolio. So even though it's only got 30% of the assets by dollars, it represents 2/3 of the volatility risk. And that's because of the significantly more volatile nature of equities versus fixed income. And that contribution to risk is a combination of the dollars invested by weight and then the volatility of the asset classes. So you see, as you move to portfolio B, still from capital allocation, looks like a pretty well-balanced portfolio. In fact, it is 57-43. It's even closer to a 50-50 than the one above. But now you'll notice that the return in this case moves up 1%. But if you look at those risk contributions, over 90% now of the risk is coming from global equity. So that speaks to the diminishing level of diversification as you move to higher and higher returns. If we can jump to the next page, and here I really want to slow down, just not to spend a ton of time, but to really hammer these points home, because I think, to me, in the way we've been thinking about leverage, and this is a topic I've been talking about for over 10 years, and some of the potential merits and really what the goal is. So I want to take a minute to set that up, because what's essentially at the heart of this is a combination or a collision, if you will, between three things. And we've got them underlined here. It's the objectives, the return objectives of an investor, bumping up against the opportunities that the market can provide, those capital market assumptions I talked about earlier, and then any constraints that are imposed on the process. So what do we need? What are the markets offering? And what are the things we need to do to control a bit and really take some of the freedoms away from investing, again, for very good practical reasons. So those are the three things, and I'll just step through them quickly and just explore, is there anything we can do about any of those three, right? So, and I'll be careful not to spend a lot of time on this first one, but the return objective, right? That's probably a conversation for another day, but can you change your return objectives? Yes, but at what cost? So that's number one. Number two, the market opportunities. Can we squeeze more out? Are there things we're not invested in? And here's I think the labeling that Ben has come up with that I think is very convenient here. And this would fall under the better assets. So are there asset classes out there that are not in the portfolio today that can help resolve this collision of market opportunities against return needs? So probably a little bit of room to find some additional investments, but limited. We're not going to discover 15 new asset classes that are going to really change the nature of the challenge. And then the third one is constraints. We talked about the very good reasons one would have constraints in the process. One that I didn't talk about is really an embedded constraint that most investors just, in essence, impose on the process without really thinking about it, and that is leverage, which is to say, in its pure definition, that modern portfolio theory I talked about puts together a combination of asset classes that sums to 100%. Embedded in that is a constraint not to borrow some money to go over 100%. Maybe it's 105, maybe it's 110, maybe it's 115. And implicit would be whether through direct borrowing or just through notional exposure through derivative markets, is there a way to invest more than 100% in asset classes? So this would be lifting of a constraint. And if you think about the comment I made earlier about as you add constraints, all you can do is bring your efficient frontier down and to the right. Well, by lifting constraints, potentially the opposite can happen. I'm going to spend half a minute on the next slide before handing back to Tom, because I want to make sure we don't run out of time in talking about these key points, and we have a stylistic example. But defining what we mean by leverage is important. I kind of gave you a very quick, assets adding up to 100%. There are various forms of leverage. It's already in your portfolio, and in fact, every institutional portfolio out there, right? You can buy an equity off of the public equity market. and there's debt equity embedded in that company. It just happens to be embedded leverage, but that's a form of leverage. There's accounting leverage, which is actually to borrow, to buy additional assets. So critical in moving down this path is understanding those forms of leverage, what it is we're talking about, what it is we're not talking about. If we can flip very briefly to the next page, I don't want to completely ignore the page, but again, I think in consideration of time, I'll just state that it's our view that leverage is probably an underutilized term. I think for very good reasons, leverage has gotten, a reputation in the past for leading to some issues in places, but it's really important to understand the details under that and the level of leverage, the form of leverage. What we're speaking about here, and what Wilshire has been advocating for many, many years now, is the modest use of leverage to try to resolve the problem I set up with that collision of factors, and really using leverage as a risk management tool as opposed to a return chase tool. And by risk management, I mean, is there a way to hang on to diversification rather than take the choice of just pursuing higher and higher concentration risk? And with that, I'll hand to Tom to step through an example of what it is we're talking about in that regard.
Thanks, Steve. If we could flip to page 44 and 45, these are, as Steve said, a stylized example of what we're talking about. A very important, critical point as we talk about a balanced risk allocation is that, generally speaking, as the efficient frontier illustrates, that asset classes at lower levels of risk typically have more favorable Sharpe ratios or risk-adjusted returns. But when you think about what that means, they might more efficiently deploy risk, higher risk-adjusted returns, but the absolute level of return can rarely meet an investor's expectation. I mean, you can see that in the table at the bottom. I'll call the first table, I won't call it a typical portfolio because it's basically equities and high yield, but you can see that it's 65% global equities and 34% high yield with an expected return of 5.9 and a risk over 13%. The Sharpe ratio there of 0.3. As you move to a more risk balanced approach on the right-hand side, you can see the risk contribution is equalized across all three. The Sharpe ratio is materially higher at 0.44, but it doesn't get anywhere close to most investors' return hurdles at 4.6%. So we move to page 45, and you think about leverage and asset allocation. What this effectively illustrates is that for those investors who are not averse to leverage, a more risk-balanced portfolio can be scaled by utilizing total fund leverage to increase the expected return to get closer to that target return threshold without sacrificing diversification. So that bottom left-hand side is essentially the right-hand chart from the previous page. You can see that those, if you added up those dollar allocations, that would equal 100%. The dollar allocation on the right-hand side would equal 200%. So it's levered 1 times, which is aggressive. And I want to make that point. That is not what we're talking about here. This is just to illustrate what happens with the portfolio. This risk balance portfolio moves the expected return higher without decreasing the diversification benefits. The risk contribution stays similar. And the Sharpe ratio, which does degrade because there are borrowing costs associated with leveraging, is still higher than I'll call it the traditional portfolio. Also importantly, these examples that we illustrated here do not utilize our current asset class assumptions. And again, we're not in the current discussion talking about a levered 1 times portfolio. This is for just to illustrate the concept. On the next page, this builds off of what Steve led off the discussion with that efficient frontier. You can see, as we look at different portfolios, that utilizing leverage, and in here we've got 2 different efficient frontiers, one which allows 10% and one which allows 25%. And you can see the portfolios which are pulled off of those frontiers. And I'll focus on the 25% leverage in gray just because it's a little bit different than the standard portfolio with no leverage. And if you just compare portfolios B and portfolio C, you can see that the risk contributions are more balanced. So they're not balanced, but they're more balanced. Portfolio B, as Steve rightly pointed out, has over 90% of its risk contribution coming from global equities. If you were to stay on that frontier and you were looking to hit a similar return expectation as portfolio C, you would have to move out on the risk spectrum by a reasonable amount. And we don't label that here because this is just showing the concept. In any discussion with the board, we would absolutely have all of those statistics laid out for you. But ultimately, if you think about what is the purpose of talking about utilizing leverage, it's to balance risks more appropriately, to try to move the portfolio's expected return higher without sacrificing diversification. Because without leverage, that's the necessary trade-off, is get more concentrated in particular assets, growth-oriented assets, in order to drive returns higher. Before we open it up to questions, and I imagine there will be a number of them, if we could flip forward to page 48, I think it's important to point out that governance is critical when it comes to utilizing leverage at the total fund level and making sure that it is in fact a total fund discussion, and that there's a comprehensive framework. Just like we talked about the board setting asset allocation policy to target specific risk and return, there should be specific guidelines and constraints on the use of leverage within the fund. And coming up with a standardized measure of leverage to monitor and manage and report on in your usual packet on an ongoing basis. And ideally, you're going to want to identify why you're utilizing leverage within these policies, and also develop some contingency plans during stressed market environments. And we talked about liquidity earlier. This is a great example of where liquidity plays an absolutely critical role in ensuring that the portfolio can maintain its level of leverage through market cycles and is not forced to delever at inopportune times, because that is in all ways value destroying. On page 49, I think it's important to point out that leverage is fungible. I don't think you should think about as leverage being utilized to do one thing in particular. I think a better way to think about leverage as leverage being utilized at the total fund level. So you have an unlevered target, and that has certain percentages, and then on a pro rata basis, you're utilizing the leverage to increase that going forward. So it's I think a really important point to think about conceptually when you think about utilizing leverage, is this is a total fund portfolio construction tool, not necessarily dedicated to one asset class, because as the next slide shows, when you're adding leverage to a portfolio, the leverage could come from different places. It might be utilized in, it might come from the equity portfolio through the use of futures, could come from the fixed income portfolio through the use of repo, but it can be utilized in other places. That's the whole point of that comment of leverage being fungible. Now, I don't mean to gloss over implementation there on slide 50, because undoubtedly this increases complexity in the portfolio. That amplifies upside and downside moves, and there's cash flow uncertainty. So having a very strong risk management process in place, liquidity management, counterparty risk management, all going to be incredibly important. And I'll just wrap up or open it up to questions there by pointing out that the way I think about this as it relates to CalPERS investment beliefs is that risk is multifaceted. that this is, I'll say, trading off concentration risk for leverage risk. In no way do we mean to imply that this is a magic bullet that can solve all problems. Leverage comes with risks in management through time, and those need to be appropriately managed in order to achieve your objectives. But I do think this aligns with that statement that understanding that risk is multifaceted and can be managed, will allow the portfolio to ideally achieve better results through time. I will stop there and open it up to the board for questions.
Yeah. Okay. Thank you, Tom and Steve. I have a question back to slide 46. The leverage in the portfolio C, the leverage is doesn't have a contribution to risk. Is that because the risk is embedded in the global equity and the core fixed income above?
So Mr. Jones, I think the best way to think about that is that the contribution to risk for global equity and core fixed income is higher than what the modeled contribution to risk would be for leverage, which it's modeled based on a cash plus a spread expectation. So it essentially, I'll say, gets swamped out. A different way of thinking about the risk impact of leverage, I think, is thinking about the unleveraged portfolio versus the leveraged portfolio and comparing the risk differences there. Oh, sorry, excuse me. I have yet to be able to figure out how to turn off the answering machine without unplugging it completely. Okay. Sorry about that.
It's okay.
My point there is this is not meant to illustrate that there's no risk to utilizing leverage. It's just that mathematically it gets, I'll call it, diversified away by the outsized risk contributions from global equity or core fixed income. But if you compare an unleveraged portfolio with similar risk contributions to a leveraged portfolio that maintains those risk contributions, there will be a difference in expected risk for the total portfolio. And you could think about that as the leverage impact to total risk. And again, those would absolutely be provided in an ALM process.
Okay. So the second question is, you made a reference to embedded leverage from companies that we're investing in. So how do we discern ourselves to what that leverage is in these companies that we're investing in?
So that's certainly a challenge, and that is it's in some ways a reporting challenge and a data challenge. In that, what we mean by there is that there's an embedded leverage in your global public equity portfolio, in that those underlying public companies utilize leverage on their balance sheet. On the private equity side, your private equity managers utilize leverage within their portfolio. On the real estate side, a similar thing. And so our point here is that we need to agree on a standardized measure of leverage and understand where it's being derived from and how it can be managed. Generally speaking, we've seen investors focus on the leverage that is explicitly controlled by CalPERS or the plan sponsor, because that's the leverage that they can move the levers on. The typically embedded leverage is managed at the manager guideline level and set in an appropriate place depending on the portfolio construction parameters of whatever portfolio we are talking about. But I think critically, it's just everybody agreeing that when we say leverage is X, this is what goes into that calculation, and this is how we're managing it.
Okay. And also, last question, the total fund leverage policy currently is 20%, but some of your comments would lead one to believe that you were looking at leverage by asset classes. Is that what you were referring to? And if not, is it, I guess, I think you mentioned a couple of sessions ago about the tracking area. Track and error would inform us of leverage getting beyond what the board's appetite is.
That's right. So to clarify, in the policy currently, there is an allowance for utilization of 20% in total fund leverage. However, the asset allocation is such that it adds up to 100%. So if utilization of that total fund leverage were to approach anything close to 20% and probably well below that, the deviation between the benchmark and the actual portfolio would exceed the active risk or tracking error estimates that we discussed a meeting or two ago. And so that active risk estimate acts as a constraint on the ability to utilize total fund leverage. So what we're talking about here is after a full accounting through the ALM cycle, setting new targets that explicitly has an allowance for utilizing total fund leverage, such that, just to use an example, the portfolio assets would add up to 110%, and it would be balanced by 10% in leverage at the total fund level. And that would become the new benchmark to which the portfolio is managed. And that's when the active risk would be measured relative to that new target portfolio.
Okay. Okay, thank you. Ms. Yee.
Thank you, Henry, and really appreciate this presentation. And I guess let me just tee off with that, because I wasn't sure whether in this upcoming ALM process we actually were going to identify the benchmark as you've just described relative to leverage, because I think there's been a lot of confusion about just what it means when we've talked about leverage. I think there's still a very popular common thought that we're leveraging the entire fund. And so I guess I want to figure out in the upcoming process, how do we kind of land this so that it's just clear about what we're doing?
That's a great question, Ms. Yee. And I think I'll lead off by saying that the ALM cycle is intentionally a long process, so that there's a lot of opportunity to ask these questions. And if the presentation of alternative policies isn't clear on what's being asked of the board to approve, that there's the opportunity to adjust to make it clearer. So that's probably, I think, the biggest protection against that misunderstanding, is the length of time that we're going to be discussing this is pretty extensive, and there's a lot of opportunity to ask questions and clarify.
Okay. Well, I'm going to be looking for, I guess, those issues to be raised along the way, just so we have that opportunity. I also just want to thank you and applaud you for the liquidity metric that you've been working on, because I think it just gives a much clearer picture than just kind of the binary, kind of liquid, illiquid kind of approach. Is CalPERS actually using the Wilshire metric, liquidity metric right now?
So they have not used it historically.
Okay, so that's available to us. And then earlier in the presentation, as you were going through the review, I was just curious in terms of how well the factor-weighted investments have been performing since they were implemented, since the last ALM cycle.
So I'll provide some broad comments. Admittedly, I don't have up-to-date figures at my fingertips, but the factored weighter component, I do want to somewhat contrast with when we were talking about factors here. These are higher level asset class factors. The factor weighted equity is within the equity portfolio, but does focus on specific characteristics of the total equity opportunity set. And that provided significant downside protection in the drawdown in March. And so really from a strategic perspective, served its purpose of mitigating that downside risk. And I don't know if Dan or Ben had additional comments on that.
Yeah, Ben, I think he said that he has a comment.
Great. Okay.
Mr. May, Mr. May.
Yeah, yeah. Thank you, Mr. Jones. Actually, I had a comment related to Controller Yi's question a moment ago on whether CalPERS is using Wilshire's liquidity metrics. Actually, we have something that we mentioned a couple of times since last year, early 2019. We have developed a very comprehensive, liquidity management framework. The concept is quite similar to Wilshire's Wilshire's framework. I have not seen a full implementation of a Wilshire's framework by other pension funds. But what we can say, our implementation, our working version of our liquidity, balance sheet liquidity management framework is much more detailed and much more comprehensive than what you just saw from Wilshire. I understand Wilshire has a limited time and space can implement, and we have fully implemented our balance sheet liquidity management framework for more than 6 months now, and we want to say that at least represents the industry best practice.
Good. Okay, great. And I feel compelled to ask a crystal ball question to both Tom and Steve. So obviously we're in a time of where forecasting returns is just very challenging with the volatility that we're experiencing. But generally, though, there seems to be at least some expression of sentiment about what may lie ahead. And I'm sure it's being complicated by the COVID-19 pandemic. But any thoughts or observations that you have heard about the impact of potentially the presidential election or the possibility of the availability of a vaccine for COVID-19?
Steve, I don't know if you want to touch on how that has impacted our assumptions, but from a short-term perspective, I can make some prognostications. I admittedly would not manage a portfolio based on those prognostications because I'm likely to be as wrong as I am to be right. I think broadly speaking, what I can say, and I think most on this would agree, our expectation is that volatility is going to persist through the election and really through I'll call it the knock on wood development of the vaccine, because we really can't get back to anything even resembling a normal economy until people feel safe. And that's what it's going to take, is going to be the development of that vaccine. And as you can see with trading in markets, you get good vaccine news and the markets rally, just kind of forecasting that going forward. And I think ideally to manage through that volatility, it comes down to maintaining liquidity, rebalancing to target, and evaluating opportunities in an opportunistic sense as they present themselves. I think that's the best course of action. Steve, I don't know if you want to talk about how our assumptions have adjusted.
Yeah, maybe just to underscore, and I think it's been said recently many times by many different people, but just the important role that in the U.S. the Fed is playing in central banks around the world, and this what feels like a disconnect between economic developments and market developments, and it's remarkable how quickly equity markets recovered, and we all know we're going through this economic phenomenon. I think it was Henry Fernandez from MSCI who made the point about this was an induced slowdown, and I think markets are trying to look past it and understand what things look like. But we don't have any edge in terms of the science of the pandemic, vaccines. It is possible. I think everybody's very hopeful and optimistic that we're looking at potentially something late in this year, early next year. But it's entirely possible that we don't get a vaccine, and and that just speaks to the uncertainty. I mean, I'm sitting here with a daughter who graduated high school and has no idea if she's heading off to college, and she's supposed to be there in a month. And I think we're all dealing with that in different ways in the overall economy. I think the risk is that the longer this lasts, and as aggressive and creative as both the Fed has been with monetary policy and a lot of the fiscal stimulus, the longer this continues, the more you move from temporary unemployment to permanent unemployment, And we've just seen from experience in the past that the employment that comes back tends to be, you end up seeing efficiency gains that companies make, and they're not bragging about that at the moment, but lots of companies are learning a lot about their efficiency. And I think no matter how quickly it comes back, it probably doesn't come all the way back, and there will be a higher unemployment rate than we came into this in. So it really has not had a huge impact on the assumptions, other than, well, it's had a big impact. You saw how volatile they were, but keep in mind this is investing out for 10 years. I think the biggest problem is what's embedded in high quality, even fixed income assets. And as we came out of '08, it was the same challenge that you all faced, which was cash is underperforming inflation, which is a horrible place to start. I talked about building blocks and stacking risk premium on top of that. You're already behind inflation with the quote unquote risk-free asset. But I would propose that the risk-free asset is actually a longer term, investment in high quality, like a 10-year treasury or even a core fixed income investment. Unlike back in '08, we're now at least if you believe the Wilshire assumptions, we're in a condition where even that asset class is now underperforming, what's built into the inflation rate. And that doesn't even speak to if all of this wall of money eventually leads to rise in inflation, which at some point it works until it doesn't in terms of inflation staying intact. So, impossible for me, and I would warn you if anybody else tries to, give you real clarity around it, I think they're kidding themselves. There's a ton of uncertainty, but the fact that there's been such a rapid pace, and if you look back, even at the last two crises, 2000 big market sales, '01, 2008, the amount of stimulus that came through took so much longer and was such a smaller amount. This was so rapid,
so
and I
fast.
think that's why you see what's going on with markets, and
Right.
and hopefully we don't have to wait 3 years for a vaccine or never, but it's very difficult to predict what the next 6 months look like. It just really is. And the good news is, and Tom made the point around liquidity, your advantage is being a long-term investor, and hopefully being able to keep your eye out on the horizon and not get caught up in all the chop. And I think the liquidity tools that staff has developed and being able to manage through liquidity during the chop allows you to not do things that are wealth destroying over the long run. So hope that helps.
Yeah, that's a great response. And then lastly, I'm just really appreciative again of the discussion on leverage and kind of the frame that you've put around this. And I guess what I would ask is, are you starting to see, to the extent that other investors are not, or getting a sense that they're not going to meet their return objectives, actually thinking about employing leverage in much the same manner that CalPERS has undertaken?
Tom, I'll take a crack at that first. We've had these conversations with clients in the past. I think we're going to run into many difficult asset allocation conversations with clients. We've through notes we've written, we've kind of prepared that backdrop. But I think until the modeling is run and we all kind of perceive, and there might be some slight disagreements between Wilshire's numbers and somebody else's. You can hear from Diane and Allison this afternoon. But in the end, the challenge is significant, and it's not just a challenge over the next 6 to 12 months. This is a paradigm where we're trying to squeeze as much out of returns, and there will be only a couple of paths to take. Right, one of them is status quo, stay where you are, accept a lower return. But the other two paths are really just more and more concentration risk versus trying to push back against that with a little more complex techniques like we talked about today with leverage, and trying to hold the line on returns, which is challenging because they've kind of come down the forward look without sacrificing diversification. And it will take, and some will look at it and say, not for me. They might not have the depth and experience of staff. So there will be a lot of challenges. I would be very surprised if we don't see some significant changes in the status quo or the traditional way that even very large institutions have gone about investing. I'd be very surprised because the challenges of the day dictate either doing that or following one of the other two paths that I mentioned.
Yeah. Okay. Great. Thank you both very much. Thank you, Henry.
Okay, yeah, and Mr. Mang, Mrs. G's other question about the uh, impact of the factor strategy on the global equity, is that something you want to respond to now, or maybe Wednesday when you guys give us an update on our returns? But
Mr. Jones is Dan. Let me see if I
Dan,
can
okay,
take a
Dan.
crack at it, and then see if this is satisfactory. I mean, I guess the short answer is it's behaving the way that we would expect it to behave. It's fair to say that it's still fairly short, short time horizon, as Ben will and I will keep trying to remind ourselves to look very long horizon in the 5, 10, to decades type of horizon. But in the couple of years that the strategy's been around, it's done what it's supposed to do. It has lagged a little bit in the up market as we had expected to, and then it has provided some downside protection and diversification in the couple of drawdowns that we've experienced, both in a very short one a couple of years back, and then of course the more aggressive one. It wasn't long in duration, but it was certainly a more severe drawdown in late February and especially March.
Right. Okay. Okay, but thank you very much. I see no further questions, so I want to thank Wilshire for an excellent presentation, and we will now take yeah, I see Ms. Middleton do it like this. Yeah. So anyway, let's take a 15-minute break. Let's return at 3:55 for our last two discussions on asset management allocation. Okay, thank you.
Thank you.
Thank you.
Thanks, Tom. Thanks, Steve.
Thank you.